Hello everybody, I'm Darren. Welcome back to another episode of TikTok Made Me Buy This Stock. So for today, we'll be looking at another video. We won't be going too in-depth into these companies, just a quick look at some of their metrics and then maybe some other factors in there, and that's about it lah. 5 stocks to buy during a market crash.
Believe it or not, guys, when it comes down to individual stocks, I've only been buying 2 lately. I've only been buying 2. And that's the misconception. A lot of people think when the markets are crashing, they got to throw money into 30, 40, 50 stocks, throw a little bit of money in each. But for me, I like focusing on a couple of individual stocks and putting more money into them, right?
Okay, so a bit interesting here, but just to catch on what he said about just focusing on 2 stocks. If you remember what Cayden has mentioned before, when you have a well-balanced portfolio, you should not have more than 10% of your total cash into a particular sector. So just a pointer.
So the first stock I've been buying a lot of is Google, ticker symbol GOOG. They own YouTube, they have a huge advertising business, the biggest search engine, right? They have hardware devices, cloud. There's so many things that Google does. And in 5 to 10 years from now, I have no doubt in my mind that this business will be a lot bigger than it is today.
So just looking at the metrics of Google, right? Its earnings per share, it's been positive. It's on the uptrend. The gross margin of Google is positive as well. It's not exactly on an uptrend. In fact, if you just try to draw a best fit line, it actually seems to be going down. But still, it's more than 40%. The return of assets of Google is positive uptrend more than 15%. Return of equity positive uptrend more than 7%. Both the operating cash flow and free cash flow are also both positive and uptrend. The debt to equity ratio of Google, it's actually less than 0.5. So if we look at all these metrics which Cayden talks about in the value investing course, you realize that actually Google fulfills more or less all these basic requirements when we are evaluating a company. As the author mentioned, Google is no longer just a search engine. They own YouTube. They earn revenue from advertising. They are in the mobile industry with Android. They run cloud services. So some of the strengths of Google, they have a very strong brand name as well as leadership. People use the word Google when you want to just search something on the internet. Hey, let's Google this. Let's Google that. You see, so there's already that very strong brand name there, and of course Google has had such a huge revenue growth in its history from when it first started all the way until now. However, of course, there are some weaknesses in Google. There's a huge dependence on revenue from advertising itself. It seems like it's almost more than 80% of its revenue comes from advertising, and we see in the news nowadays how advertising is taking a hit. So you expect Google to have to suffer a little bit from this lah. Personally, for me, I think this seems like a company worth investing in, but of course you have to do it at the right price, not just at any price. Okay, let's move on to the next one.
Disney's going through a lot right now. Short-term turmoil. The stock is down about 40% over the past 6 months, and for me, I'm looking at this as a short-term weakness and an opportunity to buy for the long term. Think about it, guys. Come on. Is Disney going to be here in 10 years? The answer is yes. Will people forget what's going on right now, or people look past it? Will people look past it in 10 years? I think yes. So for me, I'm loading up on Disney.
Let's look at all the metrics of Disney, right? Based on the value investing methodology. So EPS positive. It's been on the uptrend up to 21.8. Then suddenly it dropped. It became negative in 2020, and then it started becoming positive again in 2021. Gross margin, it has been a positive. It's not been an uptrend, but and it's less than 40%. Return of assets, it's positive uptrend, less than 15%, up to 21.8. Then again, it dropped. Same thing for return on equity. It was positive uptrend. It was more than 7%, and then after it dropped again after 21.8. The cash flow of Disney, both were positive for the operating cash flow and free cash flow. However, they were both not on the uptrend. And debt to equity ratio for Disney is more than 0.5. Well, so Disney does not fully fulfill all these criteria, but then again, let's try to take a look why it does not fulfill all these criteria. Apparently in 2019, that's when Disney first started Disney Plus, and they also started to invest in Hulu, ESPN Plus, And also there was this integration of the 21st Century Fox into its holdings. So it was all these costs of these investments that ate into Disney's earnings in 2019. So that was why a lot of that's why the EPS dropped, the gross margin dropped, the ROA, ROE dropped, even the free cash flow, right? So all these dropped because of the investments that Disney was doing. And then in 2020, EPS became negative. Why? Because of COVID, Disney had to close all its parks, close its cruises, so its operating capacities were a lot lower than normal. Then after in 2021, we started to see some recovery in the metrics. I mean, naturally, because things started to open up again. All in all, Disney has a strong brand reputation, and just like what the author say, you'll probably see Disney around for a long time. It's a company or a brand that you probably wouldn't disappear, and you still would see them making cartoons and movies and all that for quite some time to come. They've acquired other businesses to try and diversify their portfolio a bit, and there are opportunities for growth in these segments. For example, the streaming services, all right, in emerging markets, all right. But one thing to take note is that Disney has a very heavy dependence on North America for income. Also, there's increasing piracy for streaming content, right? And also there's some intense competition for streaming services. Like now you have Netflix, HBO, yeah. So you see, you have so many different streaming services out there competing in the same arena. Would I buy Disney? I would say I don't know, because it's something that I'm not confident about. It's not within my circle of confidence. But if you would like to buy again, make sure you just get it at the right price, not just at any price. Okay, moving on to the next one.
I've been loading up on VOO. This is an S&P 500 ETF, and really, if you want to be a set it and forget it type of investor, this is all you need. You don't need to buy individual stocks. All you need to do is buy this, which holds the 500 largest US companies, add into it every 2 weeks, every month, wait 5, 10, 20 years, and you're going to have a lot of money, guys. So VOO, I've been buying a lot of.
I've got nothing much to say except I agree with what he said fully. Yeah. So if you're an investor who is really just passive investor, you're not looking to constantly study the market, know what's going on, then by all means, finding an index fund or finding a low-cost index fund is the right thing to do, and then just leave your money there for the long term. So as what Cayden usually emphasizes in the value investing course, like in the long run, there's only one way where the market's going to go. So find that low-cost index fund to keep your expense as low as possible. And VOO has a very low expense ratio of 0.03%. I will buy this. I will. There's nothing much to say about this. I said I will buy it. Yeah. Moving on to the next one.
REITs, Realty Income is one of them, and essentially this is a way that you can invest in real estate without actually going out and buying a building or going out and buying a house. You can just invest in these funds, and then they go out and invest in certain types of real estate. In this case, Realty Income, they lease to a bunch of 7-Elevens, LA Fitness, Walgreens, CVS, things like that, right? Go look up more into it.
So metrics first. Earnings per share has been positive, uptrend up till 2020, and in the past 2 years it's been dropping. Gross margin positive, however not uptrend as well, but it's actually extremely high. It's 90% for its gross margin. Returns of asset positive, not uptrend however, and it's also less than 15%. Returns on equity positive, not uptrend, but also less than 7%. Its cash flow, both are positive and uptrend, and its debt to equity ratio is actually more than 0.5. So, Realty Income, this company structured as a REIT, it also gives you dividends, and its monthly dividends are supported by the cash flow that it gets from renting out all these real estate properties. What they do is that they rent out these properties under long-term net lease agreements with commercial clients, and they have an annualized dividend yield of approximately 4%. Coming from, again, value investing point of view, it does satisfy about half the criteria that we look at, and also at the same time, it offers investors returns in the form of dividends, and they're very proud to say that they've been increasing their dividends for the past 55 years and counting, right? So they're very proud of this fact, right? Because it's stated upfront on their website. But of course, for us in Singapore, we have to take note that we have a 30% tax on these dividends. And then another thing that's going on right now, as the Federal Reserve, they start to rise interest interest rates in order to fight inflation. As a result, you get a lower demand for real estate. So yeah, so that, and especially this is the space which Realty Income focuses on, right? So moving forward, I don't know how it would go or how it would turn out. But based on the metrics, it fulfills about half. And personally, for me, it's not something which I would go into because I am not too sure about this area. Okay, the last stock to look at.
The one I've been buying is VICI Properties. They own a lot of properties in Las Vegas, the big casinos, right? They own a lot of those, the hotels. They also own golf courses and just a bunch of, if you think about Las Vegas, VICI, they own a lot of that. And the great thing about these REITs, guys, is they pay a fat dividend. I think VICI pays 5% a year, which is great, and they pay on a quarterly basis, while Realty Income, they pay on a monthly basis around 4.5% a year, which is solid.
As he mentioned, VICI Properties actually is another real estate investment trust. However, this time they specialize in those casino properties. It was actually formed in 2017 as a spin-off from Caesars Entertainment Corporation after, as part of its bankruptcy reorganization. So it's a relatively new, I would say new company. So again, when we look at the metrics of VICI right now, right, you only have the data for like 4-5 years. It can be considered as a relatively young company. You don't know how it would perform in the future, but for now, as of now, earnings per share, positive uptrend. Gross margin, positive uptrend also. And in fact, its gross margin is so high, it's almost 100%. Its return of assets is positive uptrend, but it's less than 15%. Return on equity is positive uptrend, more than 7%. Its cash flow, free and operating are both positive and on the uptrend, and it has a debt to equity ratio that's less than 0.5. Yeah, it fulfills most of the criteria, but like I said, we do not have a data over a long enough period. It's a very new company. And as you mentioned, annualized 5% dividend yield. Yeah, I mean, but for me still, not for me, something which I am not familiar with and not within my circle of competence, right? So these are just some advice that we have found on social media, right? So you must always do your own due diligence before investing your money, right? And in order to do it, you need to have the correct financial education in order to mitigate these risks. If you want to learn how to, just join our value investing masterclass. And even if you know nothing, this is the right place for you to start. Sign up in the description below, alright? And yeah, that's all for me today, and I'll see you again. Bye!